Okay, well, why don't we go ahead and get started now? That's fine. People
That
can
sounds
jump in
good.
as they go. Welcome everybody to Passive Cash Flow for Life. I can't even talk today. Passive Cash Flow for Life through Multifamily. I guess Nichole kind of has driven, for the most part, this entire operation. She has been incredibly successful and loves to teach. I think maybe she kind of likes that light that goes on in someone's eyes when they get it. And I think she's just very generous and likes to share, how she got to her success. So she's been teaching for about 11 years now. I think we've had it online to be able to help more people, not just the ones here in the Baltimore, D.C. area where we live. And we've had that for about 3 years and have students in a couple of different states: California, Arkansas, Virginia, Maryland, Pennsylvania, and a couple of others as well. So the idea here is really to give you a little bit of a taste and teach for about 25, 30 minutes, something like that, and give you some good information, some value that we hope will be of value to you. And then, if you want to get more information or something like that, or you choose to take the class, it's totally up to you. We'll put that link in the description. I took the class when it was live, and just phenomenal. We may actually do it one last time. We're talking about it maybe this year, so we'll see. But anyway, Nichole is wonderful at what she does. Super successful, thousands of units across 11 states, and I will pass it over to her.
All right. Well, thank you. That's very, very kind of you. Those are nice. Thank you. If you could see me online, I'd be blushing. All right. So today, what we're going to talk about is different kinds of loans and loan products that you may see. I'm sure that you've heard some of these terms before, and so I want to talk just a little bit about what they mean. There is so residential loans and commercial loans. So there are multiple types. So I'm not even going to try and get into the different types of residential loans. What I am going to say is that if you are working with realtors, or realtors, or you have access to mortgage brokers, particularly mortgage brokers, they're going to probably be your best source of types of loans if you need to get some kind of more traditional type of loan for a residential piece of property you're looking at. Most of us in the residential space do more with kind of creative kind of financing things, but there is always room for basically different kinds of loan products. And again, your mortgage brokers are the places I'd go to. Same things with commercial loans. Most commercial properties are actually you're going to see those offered through commercial brokers. Most of the time when you're using a broker or have access to a broker, they have, as part of the work that they do to put a package together, they have basically already have a sense of who's going to make a loan on these, and they have already done a lot of the footwork to put together potential lenders. So whenever I was looking at different kinds of more traditional commercial loans, I would always look to the commercial brokers. One of the things we talked about last time is one of your best sources if you're looking at manufactured housing is Clayton Bank. They used to own Clayton Homes, which is a big manufacturer of homes, and they sold out. And with all the money they got, they opened Clayton Bank. So Clayton manufactured housing is not the favorite of a lot of lenders, but Clayton Bank sort of focuses in that space. The key is that a lot of times they are really focusing on loans that are $1 million to $5 million and more. The loans that are smaller than that, the place to go is going to be your very small local banks who have kind of a local charter, savings and loans and credit unions. All right. So what I do want to say a couple things about commercial loans is that there's a couple of places that we probably don't think about as, and I can think of a couple of others here that I didn't add that I'll talk about for just a minute. So FDA, well, it's pretty much in the residential space. They also make loans for commercial multifamily. They tend to be smaller dollar loans. And so 5 million and less, 2 million and less. And just like any FDA loan, they have to meet certain criteria, because what FDA does is they bundle them up and they sell them off to Wall Street. So they don't keep them. And so Wall Street generally has a list of kind of what the criteria is they're looking for. So your properties have to conform to that. But they have some really pretty decent loan products. They're typically longer. So they will have, in a lot of financing for commercial loans, you'll see a 25-year AM with a 5-year balloon. FDA, you can get 10 and 15-year balloons if it's a good product. The other thing that FDA does is that they also will make, they consider them business loans, so small business loans. Now, this is not the SBA, the Small Business Administration, rather, who also makes loans. You know, you may not think of the SBA as a place to get loans for multifamily properties, but they do make loans on multifamily properties because it's a business. The other place that we typically don't think of as a good place to go for commercial loans is Department of Agriculture, the USDA. They have charters to try and develop rural economic areas and downtrodden areas. And so they have some very decent loans and grants available. The thing you need to know is that they're going to be in small, so they're almost always in tertiary markets and smaller markets. And they're typically, you can find more products available in those small markets that are considered to be struggling, that need some economic development. And so I don't know if you know, but the HUD has an economic development zones, and a lot of them are in cities, but those economic development zones are also in small rural areas. So if you can find a rural area that has that is designated by HUD as an economic development zone, and it is a tertiary market, the chances are really pretty good that the USDA has loans in there that are available. So I would just, consider that if you are looking at tertiary markets that are in more rural areas. The thing that isn't on here that I just sort of that I should have put on here and I didn't is the Small Business Association. So SBA, because again, commercial is considered businesses, that SBA is going to have loans available. Now, a lot of times you see them more often in things that are in real estate that are also considered businesses, like self-storage is a good one. Laundromats, car washes, marinas. So those kinds of things that are real estate, but are also a business, that then I would go looking for the Small Business Association loans on those. And the good thing about SBA is that they do a lot of work with um, newer business owners. And so they also have some pretty good mentoring in one way, shape, or form, and or a lot of education products that can help you through some of this stuff. All right. So those are some general things. This next five I want to talk about a little bit. I'm going to talk about a little bit more, and those who I have slides for. So the first one I talk about, I think I did. So I'm coming back to this. Residential loans, I think the only thing I want to say here is that most of the time, these are one house at a time. A lot of times you have to take them in your personal name, and you're limited to the number of loans you can get. Commercial loans, we've talked about this before. I'm not going to go back over this, except to say that they are income producing properties. One of the strategies a lot of residential investors deal with when they're starting to build a rental portfolio is that they will take 5 or 6 of their single family houses and they will bundle them together, and they're going to go get a commercial loan. That takes it out of your name, and it frees up so that if you wanted to buy more houses in your name, you can. It's also a great way if you are buying properties through various kinds of creative strategies. A lot of those creative strategies, the seller is going to want you out in 3 to 5 years. And so a good way to get out is to actually get 5 or 6 houses and bundle them together and get a loan from a more traditional source, and then pay off those non-traditional controls that you have. A couple of things I do want to say here is that you do not want to go to a residential loan officer for a commercial loan. You want to go to, if it's small banks, it's typically the VP, one of the VPs. And if it's a larger bank, they're going to have commercial loan officers. The residential people just don't know what we do, and are not going to be aware a lot of times of what you're trying to do. One of the things that is really nice about commercial loans is that most of the times, they do not want you to take ownership in your own name. They want it in the name of a business, of an LLC or something like that. Okay. So, and after you've done this, bought more than 1 or 2 properties, you don't want to have things in your own name. It just increases your risks, your liability risks. So that's another reason I like these commercial lenders. And I haven't had a loan in my own name since I didn't know what I was doing 25 years ago, and I didn't know better. Okay, what I'll also say in commercial loans is it's a whole lot easier to find loans in the 1 million, $5 million plus than it is to find loans under $1 million. So that's why we talk about going to, for small commercial loans, going to places like the SBA, going to credit unions, those kinds of places that are used to dealing in smaller loans. All right. So let's talk about a bridge loan. A bridge loan is typically a 2-pronged loan, and it's going to provide cash flow during a transition period moving from one residential to one residential house to another. So one type of bridge loan is that you can move the money from one house to another. If you are selling one, you can sometimes move the loans. In commercial, it's generally used for initially for construction loan as you are trying to rehab or reposition something. And then once you get it repositioned and rented up, you move into the second loan product, which is a longer loan at a lower rate. So you can, in a way, you can think about a hard money loan, a hard money lender, as the one that you go to initially that's got high risk, it's got high interest and high points. And then once you finish the construction, if you're going to keep it, you're going to move over to another type of loan. Well, bridge loans are set up so that you basically have both in one product. And they will initially give you, they're also known as swing loans. And they are, the construction part of it is typically short term. It's going to be most of the time 18 months, 24 months and less. The smaller the property, the shorter your rehab time is going to be on that. More and more of them are more than a year. And that's what I was saying, that recently they are up to 2 years. You're starting to see that. And then it moves over into a lower interest rate loan for a certain number of years. And then it's going to be like a typical one where it's going to balloon at a certain point. Interest rates are higher to begin with, but they are nowhere near as high as what you find with hard money lenders. Although now, right now, because of the interest rates, they're probably pushing there. I actually don't know what hard money lenders are charging as an interest rate now. So after we finish these, I'd be interested if anybody has some current data on kind of what hard money lenders are looking for. I do know that a lot of the commercial lenders, even if you have really good balance sheet and have done a lot of this, their loans are 8.5%, 9.5% these days. So the interest rates are up there. Okay, let's talk about a mezzanine loan. I hear a lot of misunderstanding about mezzanine loans. People will say mezzanine loans are the same as a bridge loan, and they're really not, right? And so this is what I'm trying to talk to you here about what a mezzanine loan actually is. It's generally neither fish nor fowl. Part of it is debt and part of it is equity. And it is going to allow people to, if they want to convert their debt into an equity interest in the company if there is a default. So a lot of these start out as straight up loans that are debt instruments with an interest rate. But if the loan starts to go bad, they can convert that into an equity position, which now means they have some right to try and take over that loan and see if they can write it. The interest rates are high. And so a lot of private investors really like these, and you will see mezzanine loans not infrequently in certain types of commercial products. A lot of the big hedge fund kinds of things, you may see them offering mezzanine loans. The debt is generally embedded in the equity instrument, And that debt is known as warrants a lot of times. So if you hear the word warrant, think mezzanine loan. And it's attached, which increases the value of other debt on properties or other things. And it'll actually allows more flexibility because they can use it either as a debt instrument or an equity instrument. You don't see them that often in our level of real estate investing. They are associated a lot of times with acquisitions and buyouts. And with mezzanine lenders, a lot of times sit in a pecking order over a new owner ahead of existing owners if those owners go into bankruptcy. So mezzanine lenders are frequently sitting in front of other investors so that they're going to get paid out first. They are used most often in stable and well-established companies rather than startups or people who are just getting started in this. They are a lot of times not in the first position, meaning that the first position most of the time, because mezzanine lenders, remember, they are not a lot of times the only lender or even the first lender. So banks and other financial institutions are typically in first position with mezzanine behind them. Most mezzanine lenders are only going to work with people with track records. So I can't tell you the number of times I will hear people say bridge loan / mezzanine loan. And I hope what you take away from here is that a mezzanine loan is not a bridge loan. It is not. It's a different instrument entirely. All right. So let's talk about conduit loans. I also hear a lot of misunderstanding about what a conduit loan is. They are also known as CMBS loans, which means they are typically backed by Wall Street. They are typically real estate loans. And most of the time, they are not for one property. CMBS lenders are going to take several properties and they are going to put them together into a packet, somewhat like FDA does, but these are initiated by Wall Street most of the time, but they're going to put several loans together and then they're going to sell them off on the secondary market most of the time. Okay. A lot of people, including me, like CMBS loans. Most of the time they are non-recourse, meaning that it's the property only that is used in deciding where they're going to make a loan. And if the loan goes bad, they can't come after you individually. So most commercial loans these days, you are signing for the debt personally. In CMBS loans, all they're going to do is get the property. They are not going to come after you personally. Most of the time they are fixed rate and they are assumable. So you can sell your CMBS loan to somebody else if you so desire, if you have money in a CMBS product, right? However, they are only available for income producing properties. They're not available for construction loans, right? They're not available most of the time for businesses, right? they are a lot of times, the downside to CMBS loans is that because these loans are bunched together, are kind of pulled together and sold as a packet on Wall Street, and they're selling them to investors who are expecting to get a certain rate of return for a certain number of years. And so if something were to go wrong, if you were to try and sell a property that you have with a CMBS loan, and it hasn't run the course, you're going to be, or the person who's buying it is going to be paying a penalty so that the investor who has bought it on Wall Street gets their guaranteed return, right? And so prepayment penalties are pretty ubiquitous on these. So one of the things when we start looking at buying properties, and somebody says that this is, that if they tend to say this is not assumable, or you have to have, they want you to assume the loan. Let me kind of get my head straight here. They want you to assume a loan, right? Typically that is, not always, but a lot of times that is a CMBS loan that's going to have a prepayment penalty associated with it. CMBS loans are hard to get through underwriting because the people who have bought those, if you are trying to buy a property with a CMBS loan on it, the people who are going to okay you to assume that loan are going to want you to have the same kind of balance sheet, the same kind of experience, the same kind of everything. So they're looking to have the purchaser have the same type of qualifications as the person who's trying to sell it. And that takes longer. So CMBS loans or any assumable loan tends to take much longer to get through underwriting. So it's not unusual for other kinds of loans. You can get those through in 2 to 3 months, 60 to 90 days. CMBS loans and other assumable loans, it's not unusual for them to take 6 months to come through to get the loan approved. So they take longer, they're harder to do. And so when somebody sees that you can assume a loan, a lot of new investors get kind of excited and don't really understand what's sitting behind this type of a conduit loan, right? That there are prepayment penalties. You can assume it, it tends to take longer. The good side a lot of people like is that it's a non-recourse loan and people go for that. So I think they're great loans. You just have to understand the pros and cons of both. All right, so let's talk about substitution of collateral here. There's a lot of different kinds of substitution of collateral. So I want to say basically what it is, and then we're going to talk about it in terms of the commercial world just a little bit. So typically what somebody is doing when you are buying a house, there is typically a or you're taking over a loan, there's typically a lien on that house, right? And so what you are doing with substitution of collateral in the simplest terms is you are taking that lien and you're getting somebody to agree that they can take the lien off of this property, and you are going to put it on another property that is the same or better, right? So you're substituting one collateral, one house, or one small multifamily for another. And that's basically what it is. And so it is a it is a pretty interesting strategy to use in the residential world. And at some point, I'll bet you Sharon and Jane will talk to you about how that works and how you can really make that your something that you can use. For example, you can substitute the collateral on one house to another one that has a small mortgage balance, and now you have a free and clear house that you can sell and take the money and use it to invest in other kinds of things. So there are a lot of benefits for substitution of collateral. Okay. What I'm going to talk about here is in terms of rehabbing or loans for rehabs on small commercial and residential. And so a lot of times hard money lenders are going to lend you money on one house. And then you are so to buy it and then to fix it and rehab it, right? And then when you get to the next house, and they want to be paid back when that house sells. And though you get the next house, and what you want to do is to get another hard money loan. Well, a lot of times you have to start back over at square one. Substitution of collateral can also be used where you can put the money from one hard money loan and move it to another property. So they have it has a different lien on it, but you're still substituting the money from one lien to another. A lot of rehabbers that are doing more than one deal a year would really prefer to have the lender just move the collateral so they don't have to go out and get another loan, and they can keep that money moving. A lot of rehabbers may go, some rehabbers may, some hard money lenders, excuse me, may go for that if they know the borrower well. But most of the time, they're not really enthusiastic about that because they're losing their points as they are putting a new loan together, right? And so they're not getting the same return on their investment, right? So in commercial, in small commercial, if you think about this, I can, if I am putting several houses together that have got a creative loan on it. So I have 5 houses and they're different kind of creative financing, and they all have liens on them. So what I'm doing is I'm going out and I'm going to get a commercial loan on those 5 houses. And so I am substituting the lien from one lender, the seller originally, to another, now the bank. A lot of times I may be able to pull money out and use that money to fund other things. And so that is a cash out refi. Lenders are not really crazy about those right now, but they are real doable in this space, in this scenario, where you have a number of single family houses that have some kind of creative financing on them, and you want to get a more traditional loan and cash the seller out. And now you have extra money that you can take out to use for other things. So that's kind of what I want to say about that. And that's kind of a quick overview. I suspect I went too long. I did. I'm sorry, guys. What I want to talk about here in 2 minutes is that if you want to know more about what we do over in Passive Cash Flow for Life, you want to know about acquisitions, about raising money the right way, about managing managers, about running the business, please go watch this Passive Wealth webinar. It's free and it should be interesting to you what's there. If you want to see our website is passivecashflowforlife.com. If you have an email for us, send it to support@Passive Cash Flow for Life. We put all of these Teaching Tuesdays out on our YouTube channel, and you can see what that YouTube channel address is there. And we typically are going to put that up on Thursday, Friday. So today's thing will go up on Thursday or Friday of this week. And you will also see all of the other Teaching Tuesdays we've done. So there's the entire playlist. So we hope that you are going to find this useful. And I'm going to, next week, I am out of the country for a week, and James is going to do the class, the Teaching Tuesday, and he's going to send out an email on what the topic's going to be on this. I sort of just sprung this on him that I have to be out of town this coming week. So I think that's it for me. Let me turn it over for questions.
There's actually,
I want, go ahead. I'm sorry, James.
there was a question in chat from Aisha that you were talking about how to refinance a few properties under one loan. What is that loan called?
It's just a typical commercial loan. So you can get on a multifamily property, you're going to go and you're going to find somebody who's going to lend on it in a commercial income producing way. As opposed to a single family house, which you're typically going to go get a residential loan on. Most of the time, those in your own name. People want you to take them in their own name. Commercial lenders don't. So what you're just doing is you're bundling up 5 or more of your single family properties and going and getting a commercial loan on it. It's just a standard commercial loan, but you are, instead of a small apartment building, you are putting 5 or more houses together in this case. Does that get that, Aisha? Any other questions?
Not in the chat.
All right, folks. I know that, was this a fairly dry subject? Probably.
I thought it was good.
Gosh.
I even learned some stuff.
I loved it. I learned a lot. Can I assume one of your conduit loans, Nichole?
Yeah, sure. Sure. Yeah. So yeah, you just have to take it over there. They probably would give it to you, actually.
That would be amazing. The more and more I listen to this commercial real estate, the more I want to jump over from residential to come to this side.
Well, you know, I still do residential too, so I like both of them. I actually like
Yes.
both, but
Me
you can
too.
grow your portfolio faster with commercial. That's for sure.
Absolutely.
So, does anybody out there know what, have any sense of what they are asking in small multifamily, or what typical, what they're looking at in interest rates now? Anybody have any sense of that? I haven't gotten a small loan for a while, so I don't know. Okay. Any other questions, please?
Just where do you find the CMBS? Is it your typical commercial lender, or do you look somewhere specific?
If for you to get a CMBS loan, there's 2 ways. Are you talking about finding a property that somebody's selling that has a CMBS loan attached, or conduit loan attached, or are you talking about getting conduit funding?
Getting conduit funding.
Okay. Most of the time, those are going to be larger loans. They're typically $5-10 million or more for people to get involved in. And probably the place to go for those are some of your commercial brokers, that know who's making loans. Now, they're typically going to lend on certain kind of properties, and I honestly can't tell you what kind of properties they're looking at. A lot of them are, you see a lot of them in properties that have other kinds of, so for instance, sometimes you get tax breaks on a commercial loan if a certain percent of those loans go to are some certain percent of the rents are for low income, and so they're associated with tax breaks for certain years. You will see CMBS conduit lenders liking those because a lot of their investors need the tax breaks. And so a lot of times you see those together. It is, I just wanted you to know what a CMBS loan is. And you don't see them a lot on small properties. They're typically on the larger properties.
So two things. One, Aisha says, thank you very much for answering the other question. She's on mute. And then I went to the apartment loan store that Terry Painter runs and just grabbed something off their main page. Now, understand that these rates are like if you have like a stellar track record with a stellar building and that kind of thing. So I suspect that for most people, these rates are probably a couple of points higher. And then if you look down here at the bottom for the bridge rehab loans, they're quoting 10 to 11 and a quarter. So I suspect even that might be maybe a point or two higher. So every loan is different. So you see a quoted rate, but it really depends on the property and you. And then Nichole Aisha asked, how do you keep track of all the debt when you have multiple loans so you don't become over leveraged?
Because that's a good question. And if we go back to the basics, every property is going to have a debt coverage ratio associated with it. So how much above, so after all the bills are paid, and after the mortgage is paid, how much is left? And so by definition, the debt service coverage ratio or the debt coverage ratio is the net operating income divided by the mortgage and the interest on the mortgage. And that is typically going to be 1 point something, 2 point something. Most of them are 1 point something. And that tells you basically after all the bills are paid, what percent is left. So if my net operating income is $1,300 and my mortgage and interest on the mortgage every month is $1,000, then I have $300 left, which is my cash flow. So if I were to divide 1,300 by 1,000, I get 1.3. So my DCR is 1.3. Every property has a DCR associated with it. And so what you're going to do is you take all of those properties and what their DCR is, and you add them together and divide them by the number of properties, and that gets you your global DCR. Safe so you don't get over leveraged. I want to keep my DCR above 1.3. All right. Now that doesn't mean I am not going to have a property that is less when I am taking it over, but it is buffered by my other properties a lot of times. That's how I try and make sure I'm not over leveraged. I know what my DCR is on all of my properties, and I just keep track of that every year. Did that answer that?
I'm sure she'll type something in chat because she's on mute.
Okay.
And we have a small enough crowd that if you guys just want to unmute, if you're comfortable
Yeah,
with that,
I'm
and
going
just
to turn.
ask the
I'm going to
questions.
turn this. I'm going to stop
I had a
sharing.
question. I wanted to know about like the substitution of collateral. like if I spend the money on the purchase in the rehab, how do I substitute the collateral? Where does the money come from? Or do I have to use it once the property actually gets sold?
Okay. So typically what happens is you have to have a good relationship with your hard money lender, right? And so what you are going to do is that you would typically at the end of a purchase and a rehab, when you sell the house, you have to pay your hard money lender back, right, Omar?
Right.
Okay. So in this case, instead of giving the money back to the hard money lender, they're going to let you keep it to put on your next property. So instead of having to go back and go through all that rigmarole again and pay the points again, you just keep their money moving. So some of them like that because just like anything, how well you do, your cash on cash returns is based on how much your money's working for you over time, right? So
Right.
if you have that money coming back to a hard money lender and it doesn't go out again for 3 or 4 months, then he's losing that return. If you can keep it for your next property, then you have one up on the other investors because you have that money and you can close quick. And then, so you're just rolling that money from one property to the other. So you're substituting the collateral on the property you just bought and sold, that lien that hard money lender has, and you're putting a lien on the next property you have. Some hard
While I'm
money
in between
lenders,
properties, am I still paying that interest on the loan?
yes, you are. So what that means is that if you don't do this very often, you're probably going to be better off monetarily to just paying that lender off. But if you're doing, 5, 6, 7 rehabs a year, then how quickly you can close on a loan on a house a lot of times makes the difference. You don't have to go out and get approved for the hard money loan. You can just close on it. But you are paying the interest rate. You're continuing to pay the interest. The bedside to you is a lot of times if you are just moving the money, you're not paying points a second time. So you're probably better off in the long run. What you have to have is a hard money lender that knows you and trusts you and has worked with you before so that you both benefit. Does that answer that?
Makes perfect sense.
Okay. Other questions? All right, we've got time for about 1 or 2 more questions. All right, well then let me ask you guys a question. I'm getting to the end of kind of my list of topics to talk about. So what would you guys, this is kind of, I would really appreciate your feedback. And James, if you could take notes, I'd appreciate it.
Sure.
What kind of topics would you like me to add to the Teaching Tuesday list? What sort of things would you like to learn more about?
I would say crunching numbers.
Okay, good. All right. Don't everybody talk at once.
One idea might be just having an example and go over it from start to finish with the vetting it and doing the due diligence and all the way to the end and exit strategies and different sources of income, that sort of thing. That might be a.
All right. So actually do a couple of examples of properties we bought. All right, we can do that.
And you would just stretch those out over several Teaching Tuesdays, right?
Well, I probably try and do it fairly quickly on one, and then we may want to drill down on something, but I think you
Okay.
can get through a property relatively quickly. Not with
Okay.
a lot of depth, because that's, that takes a lot of,
Right.
that's what the whole course is about.
Right. Okay.
It might be fun even to have examples like homework for people to take home, crunch the numbers, figure it out, and then come together the next week to see what everybody.
Yeah,
came
that's a
up with.
really good idea. That's a really good idea, like that. So here's a deal. How would you make this work? How would you put this deal together? All right, any other ideas?
Charlene says, very good idea, all capitals.
Yes.
Ah, all righty.
Are you accepting any mentorships at this time?
We may, James and I need to talk about it. We've got a meeting on Friday that we're going to discuss.
Great.
What are you thinking about in terms of what does mentorship mean to you?
The mentor provides information that is specified to a project, and you're getting advice what to do next. You're looking at your the assets that you have, and then looking at what would be the proper type of loan and stuff like that. And my property is based in Baltimore.
Okay, so basically it's kind of helping you figure out maybe what kind of properties to look at, and then helping you walk through the deal to
Well,
get it closed.
Yeah, I already have a deal.
Okay,
And so I need a mentor.
okay. Well, so
Information.
you need something quicker, sooner rather than later.
Say that again?
You need something sooner rather than later.
Yes, that's true. Yes.
All right. I'm gonna let, maybe James, you want to talk to her?
Yeah, sure. Charlene, do you want to grab my my email address and then we can set up a time to talk on the phone?
Okay.
Can you cut and paste it, or you need me to put it in there again?
Oh, I can write it.
Okay, awesome. Yeah, just when you send me the email, I'll send you my Calendly link, and then you can pick a time that works for you.
Okay. Ready?
All right. Well, I think that it looks like we are about through then. And so I'm going to ask Sharon there, what are you guys going to talk about today? And then we'll turn it over to you. We've got about 5 minutes before the next person is, you guys are coming online. Do you want to tell them